On the 6th of November, 2021, the Singaporean company Sea Limited stood as one of the largest corporations in the world, with a valuation of nearly 200 billion United States dollars. Just 1 year later, the company had collapsed, losing over 85% of its value in a crash that vaporized more than $170 billion of wealth. And it was not alone. Another of Singapore's technology giants, Grab Holdings, suffered a similar catastrophic fall from a peak of $40 billion to less than $10 billion. The two crown jewels of Southeast Asia, once celebrated as titans of innovation, had become the region's biggest losers. Investors, employees, and millions of users were left asking the same simple, shocking question: what happened? To understand the shock of this collapse, we must first go back and understand just how monumental the rise of Sea Limited truly was. Its peak valuation of nearly $200 billion was not just a number on a screen. It was a symbol of a massive shift in economic power. Consider this. This single technology business was worth more than the collective valuation of Singapore's three legendary banking groups, the DBS Group, OCBC Bank, and the United Overseas Bank. These are the financial pillars that helped build the status of Singapore as a global powerhouse, institutions synonymous with stability and history. Yet, here was a relative newcomer, valued at more than all three of them combined. The achievement launched Sea Limited onto the world stage, placing it in the big leagues of global corporations. For a moment, it was the undisputed crown jewel not just of Singapore, but of all of Southeast Asia. The fall from this incredible height is what makes the story so compelling. Before we move into the specific fallacies that each company faced, we must address one other variable in the entire valuation fallout. The drop in value for these companies may have something to do with the internal management of each business, but we also need to address the powerful macro factors at play. This was a storm that was hitting shores all around the world. You see, the drop in valuation for Sea Limited and Grab Holdings is in correspondence to a lot of other technology companies. In simpler terms, this was not a problem unique to Singapore or Southeast Asia. All around the world, most technology companies were suffering. This was especially true for those in the high-growth area, a category that perfectly describes the business models of Sea Limited and Grab Holdings. These companies have faced a long list of challenges in just the past year. We have seen the rapid rise of interest rates, led by an unexpected and persistent wave of inflation across the globe. For years, low interest rates made money cheap to borrow, fueling a rush of investment into high-risk, high-reward technology stocks. Investors were hunting for growth. When central banks began to raise rates to fight inflation, the entire equation changed. Safer investments, like government bonds, suddenly offered better returns. This caused a massive outflow of capital from the technology sector, which was now seen as too risky. There is also a war ongoing right now in Russia, an event that is leading to the price of many essential commodities fluctuating wildly. This creates economic uncertainty, and uncertainty is the enemy of investor confidence. Furthermore, the entire technology sector has seen deep and persistent shortages in the semiconductor industry. Semiconductors, or microchips, are the essential building blocks of the digital world. They are in everything from smartphones to gaming consoles to the data centers that power e-commerce. A shortage of these key components means that growth in the technology industry is physically constrained. Hence, one part of the reason why the valuation of these companies had dropped was because of this long list of global challenges. The other part of the reason is also because of internal management and company-specific issues, which will be discussed later on. Therefore, the basic summary of why there is a huge fallout in these two companies cannot just be attributed to a failure in management. It must also be seen as a consequence of the world's economic and geopolitical issues. From a valuation standpoint, however, it is also true that Sea Limited and Grab Holdings have fared worse when it comes to their valuation fallout compared to many other technology firms. This also has to deal with the company being overvalued in the first place. This is another factor that we must understand. The valuation of each company had seen a tremendous, almost unbelievable rise in just a few months. They had been named as winners due to the very same macro factors that were now working against them, but from a different time. The environment in 2020 and 2021 was unique. For instance, the company Sea Limited, before the COVID-19 pandemic, had been valued at less than $20 billion. And yet, it was during the pandemic that its valuation skyrocketed to a peak of nearly $200 billion. This explosive growth was driven directly by the global response to the pandemic. The products and services of Sea Limited were perfectly positioned for a world in lockdown. Governments told people to stay home. This meant more people were shopping online, which benefited Shopee. More people were at home looking for entertainment, which benefited the online games from Garena. Sea Limited, after all, is the reigning internet company of Southeast Asia. It owns both Shopee and Garena, two of the largest businesses in their respective industries, e-commerce and online gaming. The pandemic created a perfect, but temporary, ecosystem for these businesses to flourish beyond anyone's wildest expectations. Now, let us discuss the two companies in more detail. Let us begin with Sea Limited. The success of this company was driven in part due to the conditions of COVID-19, but it was also driven by the lack of significant competition seen in both e-commerce and gaming in its home region. When Sea Limited reported its annual financial report at the end of 2021, the world saw its entire sales double and even triple in size in some areas. The numbers were breathtaking. The total revenue reported by Sea Limited in 2020 was only $4.3 billion. Shopee accounted for $2 billion of that total. Garena accounted for the other $2.1 billion. The remaining revenue was through newly introduced financial services and other smaller subsidiaries. This was already an impressive figure for a growing company. And then, just 1 year later, the total revenue reported by Sea Limited in 2021 was a whopping $9.9 billion. The revenue had more than doubled in a single year. These sales were driven by the same core businesses. Shopee had reported $5.1 billion in sales. Garena had reported over $4.3 billion. The financial services arm of the company had also grown tremendously, contributing $400 million to the bucket. Therefore, most buyers in the public stock exchange rushed in to buy a piece of this opportunity. The growth of Sea Limited was projected to continue at this incredible pace. What is probably even more surprising is that not every billion-dollar company can do what Sea Limited did. Doubling sales of this magnitude in just 1 year is a rare feat. The growth of the company, therefore, was amazing. It was applauded by analysts and celebrated in financial news. The market that Sea Limited was catering to was even growing. Much of the internet economy surrounding Southeast Asia was seen as an untapped potential, as some have indicated. Moreover, the company was also aggressively expanding overseas. They were entering different parts of Asia, Europe, and South America. They were, in other words, trying to enter every market they could, taking advantage of all the opportunities in sight. However, there was just one problem. A very big problem. These growth projections were all based on speculation. The leadership of the company in its own home region was no doubt a given. They were the clear leaders there. But there was a huge difference between being a leader in Southeast Asia and the valuation the market had assigned to the company. As of the end of 2021, the entire Southeast Asian region had an internet economy valued at just $174 billion. The valuation of Sea Limited was nearly $200 billion. How can a single company be valued more than the entire internet economy of the region it dominates? The term, internet economy, is the collective value of all internet-based commerce. This means we have to add all the e-commerce, all the ride-hailing, all the live streaming, and whatever else there is. But Sea Limited was not operating in all of these industries. The business was limited to only a few. This single statistic was a massive red flag. Speculation had then driven the company to unsustainable heights. People and investors thought that they would eat the entire internet market share of their region, and then go on to conquer the world. Then, reality began to set in. The overseas operations of the company were taking a hit. Shopee had to withdraw its operations from a lot of international markets. These included promising markets like India, Spain, and France, as well as other parts of South America. The company cited stiff competition as the reason for the retreats. The dream of global domination was proving to be expensive and difficult. Garena, on the other hand, was even faced with a larger challenge. The largest product from Garena, the immensely popular game Free Fire, was banned in India, one of its largest and most lucrative markets. This was a devastating blow, removing millions of users and a significant revenue stream overnight. When the latest quarterly report arrived in the second quarter of 2022, the cracks began to show for all to see. Although the overall sales had increased from $2.2 billion to $2.9 billion compared to the previous year, the results were a mixed bag of acceptable news and menacing news. The sales from Shopee increased from $1.2 billion to $1.7 billion. But the revenue from Garena dropped from $1.1 billion to just less than $717 million. Furthermore, the company also lost a stunningly massive amount of money. The previous quarter had only seen the company lose $24 million, a manageable figure for a growing business. But this time around, it had reported a shocking loss of $500 million in just 3 months. What went wrong? Well, we can first point out that some of the aggressive international operations did not work out and were a drain on resources. But we can also indicate that since the world has also reopened from the pandemic, the behavior of a lot of consumers has quickly changed. People shifted from what was once a captive audience of internet goods to now favoring offline retail and entertainment once again. The tailwind of the pandemic had turned into a headwind. Grab, on the other hand, was quite different. The operations of this company were more of a beneficiary due to the reopening of economies. Since everybody wanted to book a ride-hailing service to go out again, its core business should have thrived. Yet, it was still in a world of trouble, led by massive and persistent losses. When Grab had enlisted its shares on the stock market by the end of 2021, that was the only time when the company actually opened its financial data for the world to see. Before this, as a private company, the full extent of its finances was hidden. The world thought it was going to be a massive and opportunistic company, driven by big sales after big sales. The problem was, it was still operating like a startup during that time, and it needed a lot of money to make its company work. Therefore, it was burning a lot of cash to fund its growth and compete for market share. And when we mean a lot, we mean that they are burning through billions of dollars. In order to keep the company running and hit the expected growth targets, they consistently needed to keep borrowing money from banks, or raising money through other forms of financial instruments. But when can the company continue to do this? When are they going to finally break into a zone of profit so they do not need to rely on outside capital and debt? So, would we say that the drop of these two companies was due to failing management, or was it due to macro factors? Well, to begin with, the fallacies of these two companies were driven by those two large factors acting together. It was a combination of a global storm and storms within each company. Mismanagement and over-ambition plagued Sea Limited, causing it to enter markets that it should not have, and burning cash on expansions that ultimately failed. The company was valued based on a perfect future that never came to pass. Grab, on the other hand, is still fairly new in the public world. Therefore, it would be inherently difficult to say with certainty what is truly driving the company. However, the numbers show a business model that is heavily reliant on spending money to make money, a model that is difficult to sustain in a high interest rate environment. What is going to be their largest challenge moving forward would be the continuing macro factors that the world is facing today. Can Grab even continue to operate the same way it has always done, by burning cash to grow? Or will it need to pivot its strategy sometime soon to focus on profitability? Can Sea Limited regain its footing after the Garena slowdown and the expensive retreat of Shopee? These are still all subjective to just these reasons. The story of these two Singaporean giants is a cautionary tale. It is a story about how quickly fortunes can change, and how the forces of the global economy, combined with internal strategic choices, can bring even the biggest titans to their knees. The path back to their former glory will be long and difficult.